Here we are. I am Hugh Hendry. I have the great honor of, I was going to say interviewing, of spending some quality time with Richard Werner, author of The Princes of the Yen. Richard, thank you very much for joining us. And of course, thank you to Real Vision, to Raoul, and to the team for making this happen. As background, Richard, your book, The Princes of the Yen, had a profound impact on me back in 2012. So I guess I don't know if I was reading it before or afterwards, but something profoundly interesting had happened and rare had happened in the financial markets with the re-emergence of Abe San as prime minister and his three-arrow strategy to stir a revolution. Where is Robin Hood now? But the initial excitement at the end of 2012, it was 2012, had sparked the equity market surged higher, and with it, volatility surged higher, and so I was trying to construct an overly complicated trade, and I became very fascinated on Japan. And for me, it was completing a loop, because when I began in my career in 1990, I was assigned to the Japanese equity department for an investment house in Edinburgh, and I had to present on Japan for a year. So,
oh wow,
it's been with me.
Did we ever meet? Because I did go to Edinburgh quite a lot when I was chief economist at Jardine Fleming Securities.
So yeah, I guess we must have.
I was doing that particularly from 94, 95, 96, 97. And I would always go to Edinburgh and have sessions there.
Okay. So yeah, we wouldn't have that wouldn't have happened, because the model, which was wonderful, was a yearly rotation of the analysts, so that you never became. It's a bit like the gendarmerie in St. Bart's. They come from the mainland. They're not answerable to the local politicians, and in 6 months they get kicked off just in case they become contaminated. So I had moved on at that point. But your book was then sacrificially burnt by my wife. And then I was reading, I want to say a month ago, the comments page to an FT article written by Gavin Davies, and there was reference to the YouTube video, and I was like, "What? Really? Was that something you were? Were you the author of the video, or was that?"
I was very much involved, but it was two young video producers, documentary producers, who came across Princes of the Yen, and they thought this should be done as a documentary. Now, I had been approached quite a few times by documentary producers, also in Japan, because Princes of the Yen was a #1 bestseller in Japan, actually. And originally, that's how it all started in 2001. And so there were 2 attempts in Japan to produce documentaries on it. But as the Japanese journalists or editors explained to me, they got killed. So it wasn't allowed to happen. And so with these 2 young guys, and I told them, look, there will be some pressure on you, and there'll be some people approaching you and advising you not to go ahead. Oh, don't worry, we're used to that. Nobody can stop us. And I've heard this so many times from other people before: nobody can stop us, and then, oh, sorry, we have to stop this. Various things, including the English publication. I had an offer from a major English language publisher, and it was the chief executive who read the book and said, we had a lunch meeting in New York in the Four Seasons, and the first thing he said is, Richard, I read the book, as I'd sent it to him before coming over from Tokyo. Of course, we're going to publish it. So I spent the whole talk about warning him, look, there'll be some people putting pressure on you, and so don't worry, nobody can stop me. We'll publish this. Go back to Tokyo 3 weeks later, brief email. Dear Richard, it was great to see you. I love your book, but I'm sorry, we can't do it. So I've experienced this quite a lot with this Prince of the Yen. But these 2 guys, they pulled it through. And we worked together on I gave them lots of footage from my television interviews in Japan, which demonstrated the situation and the things I was saying and the story of princes of the yen, the central bank and the shenanigans. It's essentially, all the inside story of how central banking really works, what the central banks do, how much power they have, and how they manipulate the economy. And of course, it blew the cover on one of the biggest secrets in economics, money creation. Because as you know, the textbooks in economics, they say banks are financial intermediaries, and who creates money? Oh, it's the central bank, isn't it? The government. No, central banks only create 3% of the money supply. Governments don't create any money. 97% is created by the banking system through bank lending. And that puts a completely different spin on things if you realize how important banks are, and of course, how important the structure of the banking system is for the whole economy. And so with Princes of the Yen, that cover was blown. And I think people were not happy about it. Also, the other thing, particularly in America, they didn't like is that the original edition, 2001, I don't think you've read this, the Japanese, because it came out first in Japanese, 2001, and it had a chapter about my meeting with Alan Greenspan, when I met Alan Greenspan, and we discussed my paper that he had read 4 years earlier, which he remembered extremely well. And from the somewhat surprising things he said, I concluded certain things, and it's written up in this chapter. And this was predicting, the conclusion was, well, the Federal Reserve is going to do the same thing as the Bank of Japan, which is intentionally create a massive asset market bubble driven by bank credit creation, which is going to create, when it blows, the biggest financial crisis, a global financial crisis. And that's, of course, the 2008 crisis, which Alan Greenspan did create. But I think it was too early to warn people of that. That wasn't supposed to happen. So all the American publishers said, no, can't publish this. And in the end, I had a visit from a particular American agency. And, so all sorts of attempts to stop this. And I had to take out that chapter. Then the next American publisher took it. So the version you read doesn't actually have that chapter. But there is a second version of Princes of the Yen, come out recently, which has the long lost last chapter, which was originally published in Japanese about my meeting with Greenspan, what he said, and of course the conclusion, how the Americans, the Greenspan is going to create this huge asset bubble, do the same thing as the Bank of Japan, and blow up the system, which they like to do in order to do something else. Because the question is, why are central banks doing this? And well, if you want to talk about that. But
no, absolutely. I mean, I love the shameless plugging of the new edition of the book. In the same vein, don't forget Hugh Hendry official on Instagram. I know you don't like Instagram, but anyway. Can I ask how many copies does a book like that sell?
In Japan, it was 150,000, which made it a bestseller.
You're a rock star.
In the English language, not yet as much, because there have been a lot of attempts to suppress it, but it's selling well.
So let's back up a bit then. I think if I was to kind of if I was to come back at you with my understanding of what you said, is that it's this notion of what you believe to be true that others think of as a conspiracy, if you will, like reality versus these kind of the suppression. And so the reality, as you understand it, is, and I'm with you on this, is that central banks, first of all, they're not truly the agents of creating money. They're a kind of smaller, very small factor in that, in terms of the pure mechanics of the thing.
And the volume, yes.
The volume. Of
course, they have the important levers. They have the levers, but
they can make it happen. Yeah. However, I think the important point is you're saying that from time to time, spread out through the course of history, and therefore it requires typically the kind of average age of a human being on Earth, or like your adult life, 40, 50 years for the memory to subside, and then for another central bank to perhaps take on the folly of these actions. But in pursuing an ideology, they use their powers to inflate asset prices. And when that process begins, when this alchemy begins, it always ends in a bubble and a subsequent bust. Yeah.
Yes.
Is there anything on top of that that you believe to be true that others would dismiss as a conspiracy?
Of course, people, in order to suppress this sort of discussion, they'd like to, use adjectives like that or whatever, or descriptions like that. But tell me, if that was just a vague theory or some kind of conspiracy theory, how could I, even in the book that you read, there's one chapter on the ECB in there. So it's in your version, the older version, I think it's the last but one chapter. And the ECB, when this came out in 2003, the ECB was fairly new, right? It's just being created in 2000, and this came out in 2003. And I analyzed the ECB because already what they were saying reminded me so much of what the Japanese central bank was saying. Just the words, the language, the particular words, the overall drift, and how they described their actions and their justifications. It just reminded me so much of that. So then I analyzed, okay, let's have a closer look at this ECB, because the official story was, well, this is going to be like the Bundesbank, which was a good central bank, solid, no inflation, and so on, conservative. That's what we want. And we based it in Frankfurt, and the Bundesbank was independent. Therefore, the ECB will be independent and everything will be fine. That's the official story. But as soon as you scratch the surface, you realize it's absolutely not true. In fact, shockingly, it's the opposite. How could that be? Well, the Bundesbank, I think, was a good central bank. As a major central bank, probably the best, because during its existence, it never created a boom-bust cycle. There was never, during its existence, a significant asset bubble followed by a banking crisis. So they did not do that. And they delivered decent growth, and they delivered low inflation. It's like almost, the optimal scenario. So how did the Bundesbank...
But Richard, also,
yeah?
just because I agree with all of that, and what I felt I feel this urge to say that I think we should sail away from the notion of conspiracy and stuff, because I think everything in life begins with good intentions, and then life just gets in the way and it gets complicated, and we end up cheating. And it kind of, I think it's interesting, but the second ECB president was Trichet, yeah, and he was after Duesenberg, and Trichet, well, the verb tricher in French is to cheat. And so it started getting complicated, and they brought in a cheat from the French central bank. But anyway, besides that point, I agree with you, the magnificent performance of the German Bundesbank, yeah. But again, I would say that they were allowed to pursue their good intentions longer than most, because their path was less challenging because of the reconstruction of Germany. They had such a favorable wind. Arguably until now.
The path of central bankers is full of temptations, though, and they resisted these temptations. And then I analyzed, why is this? And of course, to understand the success of the Bundesbank, you've got to compare it to its predecessor. The predecessor of the Bundesbank was the Reichsbank until 1945, of course, headquartered in Berlin, the capital of the Deutsches Reich. Okay, now this central bank, the Reichsbank, was the worst central bank in history. I really put it to you. It was the worst central bank.
You don't think it was circumstances?
Oh, just listen. What they did was they did everything that a central bank could do wrong, namely, so as soon as they were created in 1876, they went straight for the asset bubble. Okay, straight on. Massive encouragement of bank credit creation for asset purchases. In my quantity theory of disaggregated credit, it's clear when your money creation takes place, it can either go into GDP, which leads to growth, nominal growth, or it can go into non-GDP assets, and then you get your asset bubbles. You have to, you look at the data, you can analyze this, and then you see what's happening. So
but Richard, you're just like you said, 1878-ish.
In the 1870s,
yeah.
there was this asset bubble, stock market bubble, and then they tightened. And then, of course, the bubble crashed, as you'd expect. And then there was a crisis, banking crisis, financial crisis. And then they tightened a lot, and it became a deflation. The 1880s was a deflation. It's very much like what I just experienced in Japan. So like in Japan, asset bubble, then banking crisis, crash, and deflation. Now, that's not the end of it. So the Reichsbank continued. It then, after the First World War, created hyperinflation. The Weimar hyperinflation was the Reichsbank.
No, wow.
It was absolutely the Reichsbank. I'll tell you
for
how.
Sure, they enabled it, but if it wasn't for it was the economic consequences of the damn peace treaty, yeah.
Well, of course, the Versailles Treaty was the external factor, but as a central bank, they didn't have to go for hyperinflation, but they went for it. In fact, the guy very much involved in this, Hjalmar Schacht. In fact, well, before I come to this, so when you look at this, why was the Reichsbank so bad? So they created hyperinflation, and then the Hjalmar Schacht, who became the president then, he essentially took the policies that got Hitler into power. That's another long story, but just take it for now.
But that's the Lord's finance. It's a good chronicle in the Lord's
finance. If you add this up, I mean, he was, Hitler then reappointed him in the 30s. He was his, money wizard. So that was the Reichsbank. So this central bank did almost everything wrong you can do wrong and got Hitler into power. I mean, hey, can you do anything worse than that? Now, why did it do that? Why could it do that? And what did the Bundesbank, what changed with the Bundesbank? Because clearly the Bundesbank seemed to be the opposite. They did almost everything right a central bank could do right. So it did an analysis, institutional analysis of the incentive structure of the central bankers. And here's the very simple summary conclusion. The Reichsbank did all this because they could, because they were independent from the government, they were independent from parliament, they were not accountable at all for their actions. There was no punishment mechanism. There was, and then what you get is you get what I call regulatory moral hazard. When the regulator, central bank is also at the same time a regulator, the regulator essentially gets rewarded for disasters because the crisis made the regulator more powerful. It gets even more independent. The same happened with the Reichsbank. After the before the hyperinflation, after it created the asset bubble of the 70s and deflation of the 80s, it was then rewarded and made more powerful in 1922 by making it independent from the government, and that was before already, but now also independent from parliament. It was turned into an international organization, accountable only to external forces, the Reparation Committee, JP Morgan. And, as soon as the parliamentary Reichstag law was signed, before the ink had dried, they started to switch on the printing presses to create the Weimar hyperinflation. Now, the Bundesbank, the people who designed the Bundesbank law and its structure seem to have studied this. Because what they've done is actually they've reduced the independence of the central bank drastically compared to the Reichsbank, and they made it accountable. And they made it accountable to parliament. So the Bundesbank was not as independent as people think. It was actually accountable to parliament, and the Bundestag, the parliament, could set laws and tell it what to do, and it did. And it told it, look, your job is not just low inflation, you also have to deliver good economic growth.
Well, we see that today, no, with the judgment from the German courts to the Bundesbank, not to the ECB.
Yes, exactly. You're right. Of course, the Bundesbank was, since the creation of the ECB, it's now, it's been a shadow of its former self, but you see the remnants still in this judgment, the remnants of the system. Now, therefore, what has actually happened is when the ECB was created, it was sold to the public as, it's going to be like the Bundesbank. But actually, if you compare the Reichsbank and the Bundesbank, the conclusion is the ECB is designed not on the Bundesbank structure. The Bundesbank was accountable to parliament. It was part of the democratic system. And, they even had a council where the different states in Germany, regional states are represented. The unions are represented on the board of the Bundesbank in the council. The ECB doesn't have that. The ECB is the revived Reichsbank, independent from government, independent from any parliament, democratic assembly in Europe, not accountable to anyone. It's a supranational organization, just like the Reichsbank was after the First World War. And of course, when you do that, when you give so much power to these people, we've seen it in the Reichsbank, power corrupts, absolute power corrupts, absolutely. They maximize their power by having cycles, boom and bust cycles. And so my warning was the ECB is going to create a huge bank credit-driven asset bubble. And as soon as the book was published, 2003, they started from 2004. bank credit growth in Ireland, Portugal, Spain, and Greece under the ECB.
20%.
20%, 30%, 40% growth even in Spain,
When it was 15 in Japan from 86 to 89, if I quote you.
Yes, exactly. That's right.
Yeah.
And of course, where was the money going? Not into GDP, going into asset markets, so property, these property bubbles. And of course, that then created the crises, vast banking system, and large-scale recessions and vast unemployment, 50% youth unemployment. Now, that was all the ECB's doing. And nobody can say the ECB had no responsibility or didn't have the power. It is the most powerful central bank in the world. It can have any tool it wants. It can do anything it wants.
No, I agreed. But I still really, I'm more a believer in the cock-up theory than this is all kind of. I for sure, I definitely, the engaging narrative that you had with Japan was a central bank pursuing an ideological aim, right? So I think, again, so tell me if I'm wrong here, this is my understanding of what you wrote, that owing to Japan's success, legitimate or otherwise, in overseas markets in terms of exports, it reached a tipping point where the American economy was really feeling it. There was the shuttering, the replacement of inefficient capacity in the States, and it was being replaced by the Japanese. And it had reached the political level, and it became a Japanese problem. Well, it became a global problem, but it was Japan's problem. And so the solution was, hey, let's pump our domestic economy to make it grow much faster. And in the process, we will automatically be bringing in more American imports, and that will take the heat and the pressure off. So number one objective is let's use the power of the central bank to dictate superior economic growth to bring down the imbalance in the overseas sector.
Yes, although they actually went further because they specifically thought about how to shock the old system and essentially convince people that the old system doesn't work anymore. If you look at the Maekawa Plan, Maekawa being Bank of Japan governor, written by he's one of the princes, and then his successor, Mieno, he actually wrote the report. It reads like the American, list, in the negotiation with Japan in the 70s and 80s, Structural Impediments Initiative. The Americans were saying, essentially, well, the true story is Japan was too successful, right? So one U.S. industry after another got wiped out by the Japanese, and the Americans decided it's got to stop. So, of course, you can't tell the Japanese people, your economy is too successful, please make it less successful. But that's the real story. So the Americans had the hard job of telling them, we want to help you improve your economy. Not really, because they'd be more successful. But, you need structural reform. You need to deregulate, liberalize, and privatize. And, you need to have more imports. And people work too hard, have more quality of life and more consumption. That's the idea. And, of course, if you do all that, yes, you get an economy that's much weaker than the high-powered, high-growth East Asian miracle model that Japan pioneered, because essentially it's about abolishing this high-growth system. And the Americans tried to cajole, and in negotiations they got some results, but not really very deep, not enough. Japan continued to be successful. Now that's when the central bankers wrote this plan in the 80s, the Maekawa Plan, and he said that, and it's quite intriguing because it says Japan will change its economic structure. It will shift to domestic demand expansion. It will, be less focused on exports. It will have more imports and that. And it was listing all these American demands, but it said that it will happen, that, this will happen. And then how? The only thing this report says is, in order for the structural transformation to take place, monetary policy will have to be used flexibly. Now, the people who ran this program of getting this asset bubble going in the 80s, because this is then what happened after the Maekawa Plan was announced. Stock prices started to rise, land prices started to rise. And if you look into the mechanics behind it, it was bank credit creation for asset transactions, for property lending, pushing up property prices. Famously, in Tokyo, Marunouchi, central Tokyo, the Imperial Palace garden, not that large, but, decent sized park. If you calculate in 89, the value famously of that using Marunouchi property values. It was the same market value as the entire state of California, including Los Angeles, San Francisco. And so the mechanism to get this asset bubble was bank credit. And I studied why did the banks lend so much money for asset transactions, for real estate purchases, and so on. And it turned out that, I interviewed branch managers of banks that in the 80s were branch managers. And they told me, well, it was crazy. We were really cold calling companies, telling them, we've got some property here. We've done all the calculations. You just sign here. We'll lend you the money. You buy this. It'll go up. You make money. And so we were creating a bubble. Wow. So if you thought this is kind of crazy, why did you do it? Well, the branch manager gave us a quota. We had to increase lending. So I spoke to branch managers of the Japanese banks and asked them, so what happened in the 80s? Oh, 80s, crazy times. We were, going out and lending left, right, and center. I was telling my staff to increase lending for property. And it was kind of risky. We were creating a bubble here. So why did you do that? Well, I was just doing what headquarters told me. Strategic planning department of the bank. They've got plans. Each branch has to increase lending by this much. So then I interviewed the people in the strategic lending department at the banks. And what I found was same story. Oh, 80s crazy. We were telling the bank, our branches to increase lending by this much and this much for property. And we were creating a bubble. It was kind of risky. So why did you do it? Well, I was just telling my staff what the Bank of Japan told us. I had a quota from the Bank of Japan to increase lending. So then I went to the
window guidance. Yeah,
that's the window guidance. I went to the Bank of Japan, and same story. And they told me, oh yeah, we told the banks to increase lending by this and this much, property lending and so on. It's kind of crazy. We're creating a bubble here. So why did you do it? Oh, I was told to do so by the head of the lending department at the Bank of Japan, the banking department, Mr. Fukui, Toshihiko Fukui. Now he ran this window guidance in the bubble era. Now, then what happened in the 90s when, of course, when you have this bubble, you just need to, it's a game of musical chairs. The music is the money creation of the banking system. You stop that, bubble collapses, the whole thing goes into reverse, bankruptcies, and then, of course, credit tightening. Now, so once the recession starts, then you get a credit crunch. And then it depends on what the central bank does, because if you leave this alone, the banks will just continue to tighten, creates more, downward reverse spiral, more bad debts. More, less credit, therefore more asset price falls, more bankruptcies. The whole thing can go on for 20 years as it did.
And it has,
But the central bank can step in. Now, who then moved up? How did Mr. Fukui and his boss, Mr. Mieno, do? Mr. Mieno was deputy governor during the bubble period, prince, and Fukui was known as a prince, one of these princes. In the 90s, these guys, they moved up. Mieno then became governor, and Fukui became first director and then deputy governor.
Now, remarkably, Mieno became a superstar because he was the architect of bursting the bubble. He put rates up, and
exactly when actually he had created it together with Fukui.
Well, he created it and then he destroyed it, and he got the benefit going up and coming down. I mean, that guy just won. But Rich,
but what did they say, Hugh? What did they say in the 90s? They said we don't want a recovery, because if we have an economic recovery, then there won't be structural change. They even said this on the record. We want to prolong the recession to get the structural change that they had planned in the 80s.
Okay, so this is where it's fascinating. Okay, because and so one of the great takeaways from your book for me was that I had been programmed to believe that again, this cultural kind of almost racism, discrimination in our heads, like the Asian savings model. They're very prudent. They work incredibly hard, and they were really struggling because property prices became so elevated, and you were having to take a 120-year loan, etc. And all of that was tosh, as you said. The banks, with this very powerful dictate that you had to each quarter expand your credit book by X%, and X being a big number versus GDP growth. And if you didn't do that, you would lose your banking license. You would lose your livelihood. So threat, success, okay? And these ordinary these ordinary Japanese folk ended up with 2-3 mortgages. It was this kind of the subprime that we saw in America many years later. So says law, supply creates its own demand.
Exactly. The credit supply creates its own demand. Banks can always push money into the economy because the credit market, there's always excess demand for money. People always will take money, and therefore banks determine this market.
This is really where I want to tap into that brain of yours, okay? Because, and this is kind of what if, you know? So the bubble burst deliberately under a change in the ideology of the central bank, that like it woke up yesterday with this uber plan for like reforming the Japanese economy and boosting economic growth and bringing in these imports and living more in a harmonious manner with his US partner, okay? And then the next day it woke up and it rejected everything with regard to that ideology, and it wanted to pursue a new path. And because of ideology, not because of the absurdity of the valuation, okay? Stock prices, you lost a bid, you lost the marginal bid, and therefore risk prices collapse. My point that I want to labor and make to you now is, what if the ideology had not changed? Where would we be today? Because that's kind of like the US is pursuing this kind of, we'll come back to that, but there's an ideology to inflate risk assets. And there's a reason, which is to kind of to do less harm than the alternative, they believe. So what if, as I said, I can see a goat coming into my house, but anyway, what if Mieno-san had not started raising rates to kind of purge the excess from the system? Take me to 1990.
Okay, well, before we do that thought experiment, I would say actually the ideology did not change. The ideology of the central bankers was always the same. You see, they didn't like the system that was in place in Japan before, because in that high growth system, the central bank played a lower level role. It was receiving orders from the Ministry of Finance. At law, the central bank was not independent. It had to do what the government told it, what the Ministry of Finance in practice told it, and it didn't like it. And that was a big issue. And therefore, it saw the chance with the American demands coming in that essentially it used the Americans as its ally. And essentially, what they did is, okay, we'll do what the Americans want. They will back us. America will back us. Japan is still occupied. I mean, there's American troops there. So then Bank of Japan has strong support. And ultimately, we want to get rid of the finance ministry control. We want to be independent, and we want to be the top cheese here in this economy. And so it's really the power play of the bureaucrats at the Bank of Japan.
This is the Bank of Japan taking out the Ministry of Finance.
Yes, and they did successfully, totally, sadly, but at what cost to the whole economy and the high growth system and, a 30-year recession. And so what they found is, how, Mieno wrote this in the Maekawa report, to use monetary policy flexibly to get a transformation of the economic structure that included political changes, deregulation, liberalization, privatization. You need to change laws. Oh. How can you use monetary policy for that? There's only one way, and that is to create an asset bubble, which you then burst. And the good thing about this, from a central bank's viewpoint, is that people won't stop you because they love it while you do it. They will take the money. You're pushing more money into the system. Everyone loves it. The politicians love it. There's more money coming around here. Finance ministry, tax revenues going up. Everyone thinks it's great. But actually, that's how you blow up the system. And that's what they did.
Sure. But, they weren't anarchists. But anyway, so let's, so it looks like anarchy.
But if they didn't tighten in...
If they did not change ideology, because so typically what would have happened, typically people like me and the people who are listeners here, I keep quoting OS as we see things differently. You and me, we're going to live forever, and we're the people that call it and say, are you crazy? 15% bank credit growth year after year, like we saw, and like you say, in Ireland, I think it was 20. In Spain in the late 80s, it was like 40%. We see that being unsustainable, and we head to the exit. We make sure we don't have assets denominated in that currency because it's very vulnerable. And then we might put short positions because we anticipate the inevitable bust, okay? No one in our community could take on the Bank of Japan because its external balance sheet was kind of almost the same as the IMF in terms of dollars held. And so no one was going to take them on Or maybe it would take another 10 years of excess. And how would Japan look if it had another 10 years? So again, it's just, I'm kind of trying to deal with this premise of because I think you've got the handbook, if you want a lot of economic growth, right? So, which is the kind of number one objective today in Western economies, which have this generation of kind of unskilled labor. In fact, more than unskilled, it's crept way up into the labor pool, where they're being displaced by, the billions of Asian hardworking, okay. And so there is a prosperity, but they haven't felt it. The whole Trump population says, make America great means make the American GDP grow at 3.5%, 4%. And you describe perfectly how we can do that, okay?
Oh, yes.
There are consequences.
System, the East Asian high growth system can be introduced in any country in the world, which means we can have high and stable non-inflationary growth without crises. It is possible.
Without crisis. Okay, so how do we get it without crisis? Is it because there's no power for speculators like me to challenge and to take it down, or
no? In fact, the speculators don't do anything bad. You let them do what they do, but
we reinforce. We are the reflexivity because it's Pavlov's dog. Yeah.
When speculators see a weakness, they seize it. So you mustn't show weakness from a policymaker's perspective, and that's possible. It is possible, and they can speculate. But you see, the main thing is this: bank credit creation can be used for growth, or not for GDP transactions when it goes into business investment. But if bank credit creation goes into the purchase of assets, because it's money creation, it's like creating new money and pumping into purchasing assets. Of course, asset prices will rise. That is unstable. It's unsustainable, because how can you stably manage this? Bank credit needs to be serviced and repaid. And that can only be done sustainably if it is for business investment, because that delivers the returns to service and repay the loan. Anything else is unsustainable, because the asset bubble, while it happens, that may be 5 years, 10 years, 15 years, it looks as if there's lots of money being made, but they're capital gains. That's very different. And it's a musical chair game.
But Richard, I'm confused, because you started off saying that this model of generating GDP growth to kind of placate and to subdue and to make happy your population at large is very, very feasible via the mechanism of bank credit growth. Yeah. But then I think what you're then taking on to say, with the caveat that it has to support business investment.
Exactly. So yeah, in fact, the punchline is that you use the window guidance. The simplest form of window guidance is just a rule. So you don't actually have to intervene regularly. You just have a rule that bank credit creation can only be used if it contributes to GDP. And that means it mustn't be used to purchase assets. Then you'll say immediately, Hugh, well, what about people that want a mortgage and buy a house that's already existing there? Of course, if you build a house, it's a different story. But if it's already, want to buy a house or an apartment, they should not get money from banks, because that's new money creation. And new money creation is only justified if there's also new goods and services being created. Then you don't get inflation. Then you have income streams to service. Then you have a stable system, and you can have very high growth. 5%, even 10%, or as East Asian countries showed, 20% growth is possible for years. But if you don't do that, and if money creation is used for asset purchases, you create instability. Now, what do people do that want a mortgage? And it has been done in East Asian countries. You set up non-bank financial institutions, mortgage lenders that don't have the power to create credit. They're not banks. They don't create credit. And they're specialists. They lend the money. And of course, the banks mustn't purchase their bonds either. And if you do that, you then ensure that asset purchases are funded with existing money. And if you want to do asset speculation as an investor or speculator, fine, but raise existing money. Don't use bank credit. Now look at the hedge fund industry. We all know, particularly the old style global macro before the crisis, they used leverage to make most of their money. Right? You just show what you do is every month, tiny return, growth, but no drawdown. And then you multiply it by 10 times, 20 times through leverage. That is bank credit. And the trouble is, that's a public privilege. That's money creation. and that has to be stopped. Now, if you don't do that, the hedge fund investors, they should get their money from existing sources. Let them get it from existing sources. Why not? But it can't be money creation. Then you're creating an asset bubble.
You sounded like the Bundesbank and very puritanical, very correct. I mean, like that hedge fund model you described really was a hedge fund model, which is the LTCM model, where faced, after 20 years of the Dow Jones Industrial Average compounding at close to 15% dividends reinvested in real terms, the greatest investment returns ever, like over a 20-year stretch. Clearly, prospective returns moving forward had shrunk to nothing, and we should have stopped speculation at that point. But of course, our Nobel laureate friends said, "Hey, but what if we, rather than 1x, 2x, we kind of 100x?" And of course, that was the idiocy of that was shown in stark relief in the crisis of 1998, was it? And it should have failed. 89, forget 89. The
LTCM, Russia, LTCM, yes, yeah. Just Asian crisis, 97.
No, 89, 90 is Japan, 98, 90.
Japan, 90. Exactly, you got it.
It's 10 years before. And the Fed had a chance to say that hedge fund model is nonsense, but they bailed it out.
Exactly,
they bailed it out. No one wants
of course, remember in that famous meeting in the Federal Reserve Bank of New York, there were two players that decided, no, we're not going to join in. Who were they? Bear Stearns and Lehman Brothers. So 10 year later, they were punished.
Richard, really, come on, stop the conspiracy. Okay, now
come on, it's not a conspiracy. Everyone in Wall Street.
But again, do me the thought experiment again. What if Mieno-san had not been promoted to head the bank, and they had kept with the same ideology, and 10 years later, unchecked, the garden palace of the emperor was worth not the value of California, but the value of the U.S. real estate sector? What would have stopped that happening? Could that have happened if left unchecked?
It probably could have continued for quite a bit. In fact, that's what most people, of course, at the time were predicting, because they couldn't see under the surface that actually,
you see the circuit breaker, no circuit breaker.
The Bank of Japan actually was really was a traitor to this. They were playing the game in the 80s, but only to bust the system. And that really people didn't realize. And even today, I think most people are not aware of that. But let's assume they weren't doing that. Let's assume they were playing ball.
In the 1980s, they were, to my mind, very, very pro-growth and kind of economic heroes, if you will, and they were saving Japan the cost of having to retreat from the international market where it was dominating. So they were protecting the beachhead. And so I think that's all kind of pro-Japan, pro-nationalistic, whatever, preserving its advantages in the face of political, but in the face of a tactical insurgency from the US, and they pushed that back successfully. The destruction and the anarchy came with Mieno and the rejection of everything they'd gone before in terms of the previous 10 years. Yeah?
But of course, as you said earlier, as hedge fund manager, when you look at a country and you see the unsustainable bank credit growth, you know what's going to happen next.
I do, if it's Thailand,
the Bank of Japan also knew what it was doing.
Sure, but if it's Japan and it's like the IMF, I'm never going to take the IMF on. And so only the foolish really were shorting the yen at that point. And so I still say to you that I guess I'm saying
the currency is slightly different, perhaps just briefly on the FX. And I've got my FX model did really well when I was chief economist at Jardine Fleming in Tokyo. And the yen was first, I was predicting yen strength, and the yen had just shot up to the highest on record. What was it, 94.79 or something? No. This was in 1994. It shot to, what was that? 79.75.
Sure. But what was the factor in the model that was predicting
the what's the factor? Yeah. You're right. And then I was predicting it's going to go to, on average, by 1996 fiscal year, 113 on average. Therefore, it's going to go to 140 in absolute terms. and nobody believed me. Once
but
because, and this is where, you see, when you study credit creation, there's a difference between domestic credit creation and the factors that influence the exchange rate. And it's quite an intriguing story. It's perhaps slightly technical, but you see, the bank credit creation is something that affects the domestic economy and domestic factors, but it doesn't actually affect the exchange rate. I mean, if you try to run an FX model by using data on bank credit creation, it's not going to work. And I don't know any that does work. And it's kind of intriguing because we just said that bank credit creation is money creation, and surely money creation should affect relative exchange rates, right? But it doesn't work. And the reason is this. It has to do with the nature of international money. We talk about capital flows, and we have this image. It's like, money flows from one country to another. But of course, the truth is, well, that was accurate when we had a gold standard, and the Bank of England had ships to ship gold in and out. We don't have a gold standard. And so the truth is, we don't have capital flows. Capital doesn't flow anymore. And there's a rule in international banking. I mean, I've been 14 years professor of international banking. The fundamental rule of international banking is there are no capital flows. Money doesn't flow. So the money created by Japanese banks is in yen, and it stays in Japan. The money created by British banks is in pound sterling, and it stays within the British banks. And so there are no capital flows. Of course, that raises a few other questions, and maybe if we have time, we can talk about this. For example, one intriguing aspect coming from this before we come back to the exchange rate is, what about all these developing countries? They've been told by the IMF and the World Bank, oh, you don't have enough savings. That's what the economics models say. So you can't have growth. We need savings. We need investment for growth. If you don't have savings, you can't have the investment. You can't grow. Oh, we'll lend you the money. So the foreign investors lend the money, foreign investment, FDI, debt, and we had the third world debt crisis, one after another. But none of this money actually came into these countries. None of it came into these countries because they lent in foreign currency. It stayed abroad, which is quite an interesting story. So
but the factor model really is that you can fool everyone all the time, right? That if Japanese asset prices are going up 15, 20% per annum, the overseas speculator wants to participate and therefore buys yen assets. And they don't look at the unsustainable nature. They just want to join the party. Yeah, and yes, so you can fool everyone all the time, so to speak.
That is a very strong incentive, and exactly.
And there's so many questions that come from that, but I'm going to push against that because for the time, I really want to again narrow down on this agenda of taking Japan's and your knowledge of Japan's experience with bubble and with monetary policy at the forefront, and take it to try and find answers or knowledge regarding today. Okay, so if I may put to you that I think it's as if the Fed, like you said, Greenspan was very knowledgeable about your output, your thinking. I kind of want to say to you that the Fed has pursued, I think, 90% of everything you've said, and then ignored the crucial 10% caveat. Okay, and the caveat, and they've done so without the dictating of you must, like window guidance, and saying you must expand credit as bank XYZ for the calendar year 2020. You must do 12%. But they haven't done that. But the fooling all the people all the time via the mechanism of rising asset prices has done it for them. Exactly. In the sense. So if we look at since the bust of 2008, broad money supply, and I say broad, it pains me to say it because they've messed around with these money supply statistics so much. But the M2 statistic, which is the dirty one that's available, kind of, as a central bank, it's a reasonable scorecard that says these guys have not been asleep like their European compatriots. Because I want to say M2 growth has averaged over the period, it's like high 7% per annum, like versus GDP, nominal GDP. That's kind of like, compare that to, if I was looking at data for France, and it's compounding at 2%. Now, 2% is not you have gilets jaunes, you have demonstrations, you have people who reject your system because you're not giving them the oxygen of prosperity. So the US is
very good, very well put. Yeah,
the US has been there, and it has used animal spirits and the recognition that you need bank credit expansion in order to suppress revolutions, if you will. Yeah. So kind of job done. You've had 3 QEs, or is this the 4th iteration? I mean, you're the inventor of the term, yeah. But
yes,
each one was criticized, but after the initial the annualized rate of expansion goes crazy on the initial exercise, but then it gets swallowed up, and again, it comes through in a steady manner, which kind of allows you to expand. This is the longest economic expansion I think the US has enjoyed. Yeah? So kind of a lot of gold stars, and yet here we are, and we do have Trump, and we do have an economy teetering and searching for revolution. And again, we have this, I shouldn't say, but what feels like a coup d'etat with the virus, but a very febrile environment, and it feels as if the system could break.
Let's say this hadn't happened, this COVID-19 hadn't happened. Then this, and that's why presumably that's why you asked the question, because the Fed is doing what the Bank of Japan has been doing, the bubble part, but it has not done the tightening bit, right?
Yeah, it hasn't rejected its ideology. The ideology that it embarked on with Bernanke in October 2002 or 3, when he said, "Let me apologize for the sins of my forefather and the strong money." It was an ideology where we sacrificed the great American worker on the cross of gold. And that will, I'm sorry, I've got your back, okay? And that's the ideology that they're pursuing today, yeah? And unless they change, again, it's like, unless they change, then we're kind of in Japan with the Nikkei at 40,000 in December 1989. So again, it's that premise.
Well, I think there will be a reckoning, because, I mean, let's just pursue this further. So we've had now this COVID crisis where, people say there's this dangerous virus killing a lot of people, although, as you know, it's kind of hard to actually show in the data. And also there's different views about, are these really COVID deaths and so on. So all strange things happen, but never mind. So we have this crisis. And as a result, we've had, I mean, the amounts of money, just astonishing, a few trillion here, a few trillion here, injected by the Fed. And where's this money going? It doesn't seem all that transparent, but can I
stop you 1 second, Richard? Because just for the audience, and I'm sure they know this, but with all of the other QE1, QE2, QE, etc., the money supply bumped to like 14, 20% annualized growth. With what they've done this year, we're running at 100%. So we're 5x the interventions of previously. So back to your point.
Yes, exactly. Thank you. Completely unprecedented monetary blowout. And it seems that this is being used by some big players to make them whole. Because at the same time, of course, we had a crash then, driven by the virus. But it seems that, a lot of big players are being made whole, whereas ordinary people, small shops, SMEs, small, medium-sized enterprises, they're being crushed, and we have vast, large-scale unemployment now. So it really seems to be under this this cover of COVID. What we have is a dramatic acceleration of this redistribution and further concentration of money in the hands of ever fewer players, while ordinary people are not benefiting. And then won't we then ultimately get this scenario, as you mentioned, like in France, ordinary people demonstrating? Well, maybe not if we have a new law which says, oh, you can't be in public, you can't demonstrate, and so on. So, it looks like the underlying tension has increased, but what we now have is laws and strong rules that we would not have believed are possible really in a country like the United States to prevent this from erupting. Now, maybe this is going to work, but maybe not.
This is very hard to have a public discourse. It's a very emotional conversation. I think our audience, we are analytical people. And 3 months ago, this was a very scary phenomenon because we lacked data, in terms of the virus. And today, the one thing that we do have is data. And when we look at it, it seems to be very hard to construe an understanding as to the severity of the reaction by the state. And they seem to have bred, the greatest fear is not the virus, it's fear itself, kind of to play with Roosevelt. But then you could think about it, there was a kind of propaganda, and indeed, 99% of the people listening to this think I'm a jerk, and I won't argue with that. But because I've come out and I've said, I think you kind of got to give these guys a break in terms of the Fed and the quantitative easing. I can see its place and its justification, but maybe you could say that we were reaching a point where people were saying this funny money quantitative easing, it's making me poorer and poorer as a regular guy, and it's making the rich 1% richer and richer. And like every revolution, what you have to do if you're the proponent of the revolution is that those who were very against you, those that hated you, you have to convert into your most loyal lieutenants. And how do you create that transformation? You do so via some mechanism which ferments immense fear. And like now, I imagine with 20% unemployment, with the GDP heading to being down 20% year over year, people will be demanding, pleading for you to give them more of what they were rejecting previously, which is which is the funny money. But again, I'm now sounding like you and your conspiracy theories. Tell me what the Fed is doing wrong today, and how you would change it.
By the way, I don't have any conspiracy theories. I'm a scientific empirical researcher. But sometimes when the conclusions tell you to conclude something based on facts, you have to be bold and state it, even if some people don't like it.
No, you're a crusader. You're brave. I respect you. I'm just playing with you.
Okay. So what should the Fed do? Well, of course, ideally, the Fed should have followed the rule of my quantity theory of disaggregated credit and ensured that bank credit is used only for productive purposes, and then we wouldn't have had this asset bubble. But never mind.
I think that's a cop-out, Richard. I think that's a cop-out.
Yeah, never mind.
I think but it's a very important cop-out, because that is like all of your wisdom from your book hinges on the one caveat, which is what you've just said, that all of the money, so the central bank can create a tiny part of the money, but it can influence the totality, okay, through either coercion.
That can be easily done. We just need a rule, connected to the banking license. Okay, but even no,
sure, I say also, but you're saying, forgive me, but you are saying that is the panacea with one condition, that all of that money has to fund productive investment. And of course, the retort to that is, well, what if the productive investment opportunity is pea-sized, and we need something which is the size of a basketball to stop the revolution?
That's not a problem, because we have humans, and humans are creative, and they create ideas, they create technology. There's so much great technology that hasn't been implemented because there hasn't been money, because the incentives have been wrong and the wrong things are being funded. But leaving that aside, even if they don't follow this rule, and they haven't followed the rule, what I give is advice on what to do. And my other book, New Paradigm in Macroeconomics, I mean, it predicted we get this banking crisis, 2008 banking crisis. And I even wrote what they're going to do after the banking crisis, all the wrong things. But I told them, actually, you don't have to do these wrong things. You can do this. And what is it? First of all, when you have a banking crisis, you don't need this to turn into a recession, because you can take away the bad debts in the banking system at zero cost to the taxpayer. How? That's what the central bank can do. If a central bank purchases them at face value, they're wiped off the bank's balance sheets. And the central bank, well, it doesn't feel the pain. So end of story. And then you've solved the problem, and banks can create credit. Of course, you should ask for strings, when you should attach strings when you bail them out in this way, which usually they don't do for some reason, but you should. And you should say, well, from now on, create credit for productive purposes, and you'll follow this procedure. So it could be done very easily.
Does
but
that
now
mean that the
we've got a
banking
different
sector
crisis.
has to be nationalized? Does it have to be then an explicit adjunct of the government?
No, I'm actually quite against that. But I'm glad you mentioned this, because what we're now witnessing is, and particularly with this crisis, is really accelerating this. What we're witnessing is a trend towards Sovietization of big chunks of so many economies. It is shocking, even in the US, essentially de facto nationalizations and centralizations. Now, the overarching trend of the 20th century was the trend towards centralization, ever more power in the hands of fewer people. Particularly central bankers have been beneficiaries of this, and each crisis gives them more power, which is why we have this moral hazard, regulatory moral hazard. They benefit from crises. But this is now accelerating, because what they're saying now is, and the central banks have been saying this, Hugh, you must have heard this many times, cash is bad. And once the COVID crisis came, oh, now really cash is bad. The virus could be on it. We want to abolish cash. Banks are bad. Oh, banks create money. You know, once I lifted the lid and blew the cover, they switched to plan B. We now have to abolish bank credit creation. Why? Well, what if Joe Public realizes banks create money? They could actually go out and create local, not-for-profit banks for the benefit of the ordinary people. That must be prevented. So now we want to prevent bank credit creation. And this is happening now. The central bank this is a historic moment, not witnessed in 300 years, that this concordat, this agreement between the central bank and the banks, has been ripped up. What is the agreement? The agreement is the banks create the bulk of the money. They have accounts. That's where retail and businesses have their accounts. They deal with that and they create the money. But the central bank is the top dog. But the central bank, in exchange for being top dog and having coordinating power, it keeps out of that business. Retail doesn't have accounts with the central bank. Businesses don't have accounts with the central bank. That is the agreement, and there's been a balance in place worldwide. And of course, central bank issues paper money, but it's only a small amount. Banks don't issue paper money anymore. And so that was the balance. This has been ripped up because now the central banks, who are regulators of the banks, are announcing, they've announced it, that they will now compete with their own regulated. The central banks will now begin to compete with the banks. How? Well, this digital central bank currency is nothing but a current account at the central bank. So everyone will get an account with the central bank. This is going to be essentially the thin edge of a wedge, and the end of this is going to be no more banks. Because if the regulator moves against the regulator, I mean, talking about conflict of interest, I mean, the regulator now has an incentive to get rid of banks. They've started it. They've declared war against. Yeah,
so it's a hidden nationalization. You have to do it because in America the whole language of socialism is wrapped up in communism, and so you have to therefore make it a technical change in order to achieve a nationalization.
And so we'll end up with the central bank being the only bank. That's what we had in the Soviet Union, and that's not good.
But so again, Richard, my mind's like fireworks are going off as I listen. Sovietization, that centralization model, okay? When you said that, and when I considered our starting point, which was Japan, and we said that actually Japan post-war, Japan post-war adopted its very successful economic strategy pre-war, yeah? It was a very, very strong economic model. And they were, like as your book depicts, all of the architects of it were slowly and surely and invisibly put into positions of power again. And they recreated it. And Japan became an economic powerhouse. And then that was brought down by the anarchy or otherwise of the Bank of Japan, okay? What if it's the rise of the phantom, if you will, that actually we're going, because what if we're actually going back and it's the takeover of, let's be positive, what if it's not Sovietization, but it's actually returning to the thing which was phenomenal, which was that Japanese centralized economic growth machine?
Okay, we'll be able to tell which one it is by the number of banks. Japan did extremely well because it had many, many banks. in order to ensure that bank credit is used for productive purposes, you need a lot of banks with many branches where there are actually experienced bankers that know how to read a balance sheet, that know how to kick the tires in actual companies, small companies. That's hard work, and make the right decision. That's when it works. When you have this multifaceted banking system, Japan has many types of banks and many banks. So that works really well. Now, let's compare the Soviet Union and China. The Soviet Union, because until Deng Xiaoping took over in China, China is very similar to the Soviet Union in many ways. The Mao communism was like the Soviet Union, Stalinist type of system that did not work very well. How many banks did the Soviet Union have? It had one bank only. That bank had branches, but it was one bank. And that doesn't work. Why? Because you don't have this detailed, decentralized analysis of people on the ground in the many geographically remote areas, analyzing on the ground all these small firms. It's the same the world over. Most employment is with small firms. In the UK, it's 66% is SME, is employment of all employment is SMEs. In Germany, it's 70%. In Japan, it's 80% of employment is with SMEs. And that's where the jobs are, which is why we're now in trouble, because that's what they've been shutting down. This is a direct assault on the majority of people's employment. Now, China. When the Chinese saw this, and particularly when Deng Xiaoping came to power, he realized, the Soviet Union, soon after, in the next decade, essentially went bust. The system didn't work. And Deng Xiaoping realized this. This is not going to work. We have to bail out. Of course, he wasn't going to give up communism, but he wanted to rejig the system. And what he did is he switched from centralization to decentralization. As soon as he started, and of course he'd visited Japan, he copied the Japanese model, and he realized we need banks, many banks. He established thousands of banks. China created thousands of banks, and that delivered this high growth. And of course, then window guidance did the rest. Now, look at the US. The US overall has performed very well as an economy over the last 200 years. I think that's fair to say, because it had higher growth in the past, and the growth rate has sort of come down. And that is proportional to the number of banks. Before the Great Depression, America had close to 30,000 banks. The Federal Reserve closed 10,000 banks during the recession, unnecessarily so, and the system became more concentrated. And also in every industry became more concentrated. The farmers that used to own the land, family-owned farmers, the whole country in the 1930s, they were expropriated. The banks took the land from them. It became mega agro-business, centralization, almost Soviet-style, huge kolkhoz type of agro-businesses. Now, what about just the recent period? If we go back only 15 years, America had 15,000 banks, which is the largest number of banks in any country in the world. Okay, America is big, so they need more, but still, that's the largest number of banks. But today, how many do we have? We only have barely 5,000. Why? The Federal Reserve has continued this policy of whittling down the number of banks. And one way to do this is to have lower and lower and lower interest rates and a flat yield curve and a negative yield curve. You are driving banks out of business. You're forcing them out of business. The same is happening in the Eurozone. Under the ECB's watch, hundreds and hundreds of banks have disappeared. In Europe, the country with the largest number of banks is Germany. And the secret of German economic success, which also has had a very good economic performance the last 200 years, has been the decentralized banking system. 80% of German banks still today are not-for-profit local community banks. So you've got many, many small banks. The high street big banks, they're only 12% measured by deposits. So it's these small banks. Why do you need small banks? Because small banks lend to small firms. Big banks have no business lending to small firms. They're not interested.
No, I get that. But the number of banks is going to be the determining factor. So I'm conscious of our time and whatever. And so I kind of want to leap from there because you're suggesting perhaps an agenda, a takeover agenda by the central bank. Okay.
There's something we can do. We can set up not-for-profit community banks. I'm doing this in England, by the way. So any investor who's interested, we're setting up community banks. They're not for profit, but there's going to be a dividend. We're starting with the Hampshire Community Bank. We're doing it all across England now. We can do something. We can work against this, and we can help SMEs now, and it's needed more than ever with this crisis.
Absolutely.
We're setting up these banks across the UK. You don't need much money to create a bank. So if you ask me, Richard, what are you doing these days? Well, I'm creating banks. And we're very close to getting
setting up a hedge fund. That's what hedge funds are doing, disintermediation of the banking sector, and a review and analysis of the credit risk, underwriting the credit risk, and making the capital allocation. But what I wanted to say to you that I think your idea would be legitimized if we saw a step forward. So again, with our patron Raul listening in, I'm sure he wants to kick me and say, "Hey, wind this damn thing up," but he wants to kick me and say, mention negative interest rates. And so before I hit you in with that introduction, I think the negative interest rate, Raul, forgive me, but I think what it neglects is the no-brainer first point, which is you take away the central bank. I think, correct me if I'm wrong, but I believe the Fed pays 10 basis points to the commercial banks for them parking reserves on the central bank. And I think in Europe, it's something like 50 basis points. And that is an incentive for stasis. That is an incentive to do nothing. And so if I was involved, if I was running the Fed or the ECB, the first thing I do, I go to zero. And in fact, I would probably charge rent. I say, if you put your money on my balance sheet, you're going to have to pay 50 basis points.
It is negative. In Europe, it is negative.
Oh, it is negative. Okay. Oh, so they're doing that. And in the US?
No, but for some reason, Trump is saying, oh, in Europe, they're doing it. That seems to work. Not. Let's do it in America. Of course, the Fed is heading in this direction. And I agree with Raul that, I've been saying bond yields are going down and they're going to be zero and they're maybe even going to be negative, but also Fed rates, we're heading towards negative territory. But what does this mean? This is actually bad. And the ECB has been doing this as part of its goal to destroy the community banks because they want the Sovietization. They want to drive out banks, then introduce central bank digital currency. Lagarde has announced it. We need to do this. And then they're the monopoly, and they're even more powerful. I mean, can you believe it? The ECB is already so powerful, but they're still going for the last power grab. They want to be the only bank around by bankrupting the rest of the banking system. Now, this crisis has the risk of accelerating this trend if we don't work against this. So we need to act now and create more banks.
I wanted to ask if there are any accentuating circumstances where you can legitimize a central bank fostering a strategy onto its commercial banks to generate asset price growth, to create that magic feel-good module, which then would expand the legitimate pool of productive investment, which would ultimately take the economy on. And so Machiavellian, can I kind of inflate, because I've got money supply and I've got to determine how much I fund speculatively to productive, and presently the productive feels kind of small. And so why not push the gas speculatively, generate, GDP growth last year in the States was really good, and keep that on, and then that will inflate. Yes, it will inflate asset prices, but it will inflate productive investment projects. And then I just take the gas off one side and I start pushing into productive investment opportunities.
I think you've described this really well. I think this is the sort of temptation that central banks probably always feel, and certainly in the last 2 decades, and certainly very much after 2008. And it's probably the underlying justification for what they're doing. Well, we need to somehow kickstart this, so we need to get the juices flowing. And yes, and of course, economics textbooks do the rest, because they don't recognize bank credit creation. They think banks are just financial intermediaries and the stock market is key and so on. But actually fundraising for companies in the stock market is limited. It's mostly secondary trading of already issued stocks. So there's a bit of a misunderstanding there. But the official story is, all these markets and asset transactions, somehow that is fueling investment, real investment, even though really, these are asset transactions and changes in ownership rights, which are not even part of GDP. That's the reality. Because they don't add value. And that's why.
Here's a contentious point too, but we created Google, Facebook, and all these new companies all came out or were part of the process of the bubble in technology, at the turn of the century. So was that bubble worth it, given the legacy seems to have been these platforms, which then went on to impose an enormous economic rent on the rest of the world?
Yes. Well, and I think that there is this story behind it that certainly Greenspan seemed to have felt it's all worth it, and by injecting all this money, he can fuel the right type of things. The trouble is, it will not just support the productive investments, and it's very hard to then taper off at the right time and ensure that it just doesn't become an overblown asset bubble. And that's almost impossible, I would say, which is why that's the trouble, that central bankers therefore always feel tempted and almost always fall for this temptation.
I think you're wise to say impossible, but the 2008, some of us kind of profited from it because we could, and you could see it, etc. But it wasn't just the credit mechanism being fully on, like foot to the pedal to the floor. It was the fact that the asset price that had become inflated was the US housing stock, which was like 10x GDP or whatever, a very high X GDP. And therefore, if you got a contraction in the asset price, it would wipe out the economy. Like GDP would just go down hard. And prior to the virus coup d'etat, whilst we'd had this new all-time highs in financial markets and asset price inflation, there was no existential real threat to GDP because there was no explicit asset market, which was so big that if it had a reversal, it would knock us over. Do you agree with that?
Yeah, I think so. And certainly the temptation was there, and risks were taken in creating this asset bubble because there was this argument to justify it. But in reality, it was clear. I mean, certainly by the end of last year, it looked like such an asset bubble. If we didn't have the COVID crisis, I think it would eventually also have to crash.
But why? That's the point. I don't understand that. I want to push back. Why was it such an asset bubble?
You can continue it, but only if you continue to play this game of ever increasing credit creation for asset transactions, ever more.
And my point is, why not until you reach a kind of tipping point where you say, well, this asset, like student loans or car loans or mortgages to households, it's reached a point of X times GDP that I can't push it anymore because, unintended consequences. If it comes against me, I wipe out all my gain. And so you say unsustainable asset bubble. I didn't see the Achilles heel, and therefore it wasn't unsustainable at the end of last year.
Well, certainly, as you mentioned, when the yields and the returns and the earnings become so small and the gains are all in the capital gains, then there becomes a point when it doesn't make sense. So you push beyond that. It doesn't make sense, but it's a game. It's going up. Everyone is investing. It continues. I think the risk there is, particularly for insiders and central bankers, central planners, is that something else that they don't control could trigger the collapse. And maybe they don't like that. So they'd rather, and maybe this is what happened in February, March, but sometimes maybe they'd rather trigger it themselves so then they can have, somewhat control over the collapse and benefit from it. Because of course,
again, so never make yourself. My point is, if I'm running the thing, all right, I've got to be the chief, right? I've got to be Tony Soprano, and you will never dare take me on. Yeah, that's the role of a central bank. You should always be Tony Soprano, okay? And so you can never. So you pump, but you can never allow an asset price to become such a large component of GDP, like a factor of GDP, such that it pimps you. You got to pimp everything else. Forgive me for my colorful language. And again, I don't see, like in the absence of the coup d'etat, I didn't see the vulnerability to the omnipresent Fed. So, Richard, I definitely picked up a lot of flack over the years because I I developed an ideology. I won in 2008 and I lost 2009, 10, 11, 12. I became curmudgeonly and I started saying morally the Fed was wrong. And I started quoting Andrew Mellon and we should be purging the rottenness from the system. Felt very Calvinistic and I was very comfortable. But it wasn't my role. And then when I reset it, I thought to myself, if we had pursued the hard money agenda, the US post 2008 would have kind of gone down like potentially 10%. We'd have had bank closures. We'd have had unemployment of 20%. And I said to myself, you know what? Anything is better than that. And these guys they're not hedge fund superstars. They're not paid like millions and millions of dollars. And they're judged by history. And so they're cautious. And yet they took brave decisions which could have backfired and maybe are backfiring. But, they were willing to put their head above and to be knocked down. And they've been the architects, I think, of the longest US expansion. So I want to say what the Fed has done. I want to say that you were the first person to coin this term, quantitative easing. I want to say it's been a source of good. And I know that's going to piss off everyone listening to this. Do you agree or disagree?
I have to agree with you, but there's some caveats, as you might expect. The QE I proposed originally in 1995, published in the Nikkei, was literally credit creation for GDP transactions. That was the definition of QE. And I called it quantitative easing. The editor at the Nikkei said, I can't have credit creation in the title. I must think of another name which gives the idea that it's different from standard monetary policy, but it's, and of course, what I'm proposing is about the quantity. So I used quantitative and then easing as the Japanese way of having expansionary policy expressed. Anyway, so with that definition in mind, the Bank of Japan wanted to disprove QE. For years, they said that's nonsense. Then in 2001, they announced we're adopting QE, but they went for the straight traditional monetarist high-powered money expansion, which even my original article I said is not going to work because if you increase banks' reserves by how many times, that's not going to do the economy any good. You need credit creation. So they tried this from 2001 to 2006, high-powered money expansion. Didn't work. So they said, oh, now we've told you, we've shown you, as we told you, it just doesn't work, so we stop it. And they stopped it. But then when the 2008 crisis hit, from 2009, the Bank of England said, we're going to do QE now. And they followed more or less in the Japanese footsteps. Now, in America, Bernanke came out and said, we're going to do something that may look similar to QE, but Bernanke said, want to call this something else. I don't want to call it QE because that QE didn't really work. I mean, he was polite about it when he said this. There was a speech at the LSE 2009, January. And he almost said what I've been saying, namely, they did this wrongly because just high-powered money expansion, that doesn't do any good. We need to expand credit. He said that. And therefore, he said, I'd really like to call this some kind of credit easing. Well, that's exactly the quantitative easing I meant. And he also, and of course, Bernanke, remember, in the 90s, he was very much interested in Japan. And he was part of these debates we had about Japan and the policies and what needs to be doing with the crisis. So he's very much familiar. And I think he knows my work and the credit creation expansion definition of QE. And he was the only central banker who did at least half of what I recommended. The one half being, you've got to help the banks. And you can do this best by purchasing their non-performing assets, take it off their balance sheets, move it to the central bank where they can't do any harm. And then the banks can create credit again. And that's what he did. And that's why the Fed balance sheet, of course, quadrupled in a month. And bank credit was the first in America to recover. Already 1.5 years later, 4-5% bank credit growth. And as you mentioned, then of course you get your economic growth. Of course, it wasn't perfect. It was still biased towards big players. And Main Street didn't do so well as it could have if they had not at the same time had this policy of reducing the number of banks, you see, which I mentioned earlier. So they should have abandoned that policy and actually said, no, let's create more community banks and let's help them to push the money. And then it would have been even better. But I agree with you, given circumstances, the Fed actually was the central bank that did best, and because it did the best proper definition of QE, it was closest to my definition of QE by expanding bank credit creation, helping banks.
I'm glad that's at the end, because if we had that at the beginning, everyone would be switching off in disgust, as the two of us agree that the Fed scorecard is really, it's a heck of a lot better than the alternative, yeah? And again, the legitimate point to all of you haters out there is, despite all of that, what seems, like you say again, is this illusion of money supply growth, yeah? The reality is quite different. We don't, again, let me just reiterate, we don't have a specific asset bubble within the US economy, which is of such a magnitude that if it reversed, it would take us down. And I think that's why we've had to adopt, invent, whatever, this crazy virus scenario that we find ourselves in. But okay. Now, negative interest rates. I have 2 points. When you're doing contentious, controversial things and you're a bureaucrat, it's kind of better to hide your tracks. And I'm kind of making this up, and I, again, may make an ass of myself, but is it not better simply to make that technical change where, like you were saying, the ECB, I think, is -10, or what is the negative rate that they charge for commercial banks depositing?
I don't know.
It's something very small, but why not make it?
But it's negative.
Why not make it? But why not? Why the first step is, why is the Fed not there? The Fed should be negative, right? Because no one, if you do the explicit negative rates, then savers are up in arms. But if you're actually coming through and hitting banks, everyone loves you. It's a populist measure.
Hugh, but it's nonsense. It is nonsense, because it's based on this idea that the reserves that banks have at the central bank is the same money that the banks can take from the central bank and lend out. But that's not true. Reserves at the central bank cannot be lent out.
No, indeed. And that's why it has to be punished. You have to say, listen, my number one objective here.
No, Hugh, there's a misunderstanding. The reserves that banks have at the central bank is 100% determined by the central bank.
Because I was thinking,
because it's special money. It's not real money. It's not, it's a different type of money supply, which is it's completely isolated from the rest of the system. It's a circuit between the central bank and the banks, and it's credits that the central bank gives the banks on its balance sheet. Okay, but that money can never leave, so that never helps the economy. Therefore, and this tells you that the central bankers who know this jolly well, they're misrepresenting this to the public. The public doesn't know this, and you can't expect the public to understand this. But the central bankers, also the ECB in particular, they've been saying, we do this negative interest rate policy to punish the banks, as you say, and encourage them, force them to lend this money out. But this money cannot be lent out. And so instead of encouraging the banks to lend more, it's simply a tax on banks. And if the banks are already squeezed by the interest rate scenario they've created, short rates being very low, long rates being pushed down by the QE purchases, and you have a flat yield curve or negative yield curve, the banks are not earning money, you are actually really hurting them. Then you put a tax on them, you are driving them out of business. And that's why hundreds and hundreds of banks in the Eurozone have given up. They're forced to merge. They disappear. That's very quiet. People don't talk about it, but you get a more concentrated banking system. And that is what's happening. And this is now going to accelerate, I fear, under this crisis. And therefore, we'll end up with the Sovietization of the banking system. Ultimately, the central bank is going to survive only. And at this moment, where the banks are so much being squeezed from all sides, you have the regulatory layer, they have Basel III, Basel IV now coming up, which increases costs for banks again. At this moment, where the banks are being squeezed from all sides, and they really can't make money much, and they don't know what to do, they're forced to merge, that's when the central banks announce, we're going to actually now compete with the banks. And the banks, it's the regulators saying this and doing this. They can't complain about this. It's unfair competition. They have no chance if the regulator suddenly competes with a regulated. And this is what we are facing. So that tells you that really it's because the central banks know this very well. It cannot be by accident. That is their intention. I'm very much, Hugh, when you say earlier, this sounds a bit like a conspiracy theory. Well, I'm just very much with Paul Samuelson on this one. He proposed in 1937, I think, one of his first pieces in economics, the theory of revealed preference. And it says that you shouldn't just believe what people tell you, because maybe they're confused themselves, or they may tell you what they like to do, but actually that's not really what they're doing. So cut through that and actually watch what they do. And that's become, when I started to monitor central banks, and I'm monitoring 38 central banks now, looking at their liquidity with my Liquidity Watch report. As I do that, my fundamental motto is, don't listen to what they say, watch what they're doing. And that reveals their true intention, because they're in control in most countries, very independent. They can do what they want. And if they do that, we have to assume that's what they want. And so the central banks seem to want to put banks under pressure and make it worse through negative interest rates, and then even outcompete them on their own home turf by opening accounts for the public with the central bank. That's the reality.
So I seem to be like out of my depth a little bit in terms of how big are those reserves, commercial bank reserves at the central bank, in terms of, has there been a structural shift like pre-2008, post-2008? Is it a lot more money parked on the central bank's balance sheet by diktat?
Yes, absolutely. And the same, we saw this in Japan first. So in Japan also, then these reserves increased tremendously. Now let's look at currently the Fed. And it's actually quite relevant, because the Fed has just announced that they're going to reduce, well, they have reduced now the reserve requirement to 0. And again, it tells you they're just playing with us, because this is like misinformation.
What does that mean? The reserve requirement is 0 for those?
It's irrelevant. It's now 0, but it has.
What does it mean? What does that mean? Like, so if you know nothing about banking, what does that mean?
The reserve requirement. Well, in the old days, we had the fractional reserve theory of banking, which in my empirical papers I disproved. It's a wrong description. Actually, Samuelson, that's one of the things I disagree with him, did that wrongly. The money multiplier model is actually not true, but it uses the reserve requirement. The inverse of the reserve requirement is the money multiplier. Essentially, it's a requirement for the banks to hold certain amount of money as reserve with the central bank. But the truth,
so if you go to 0, does that mean you've gone to an infinite money multiplier?
Yes, but the money multiplier is nonsense, because in reality, the central bank controls how much money is on, it has from the banks in reserves. It creates for the banks.
But again,
and therefore, in practice, reserve requirements were never used for monetary policy, only in textbooks. But especially, look at the current situation when the reserves are so large. We have huge excess reserves. And then they say, oh, the reserve requirement was never a restriction anyway. It's fairly low. And the actual excess reserves are much larger. And they're now saying we abolish the reserve requirement. It's just like, it's misleading, because it's irrelevant anyway.
But I don't understand, because it doesn't matter. Are you telling me that the central bank sponsored the build-up of commercial bank reserves at the center, or are you? Because my feeling was it was the risk aversion of the commercial banks that parked the money with the central bank.
But the central bank reserves, i.e., banks' reserves at the central bank, they cannot be lent out. They cannot be lent out. They will always stay on the balance sheet of the central bank. So it's not as if we can now take this money, the bank takes the money and then gives you a loan.
But that doesn't work. I am JP Morgan, and I've got $1 trillion of loans outstanding in America, let's say, okay? Is the requirement of that trillion I've got to post, $100 billion with the central bank?
Not anymore, because it's now 0.
It's gone to 0, okay.
And before there was a tiny amount. Usually in the last, 30 years, it's been around 1%. Needs to be in reserves in those countries that still had reserve requirements. The UK, Sweden, they already gave up reserve requirements over 10 years ago.
Okay, but there's no bureaucratic mandate imposing the need to post reserves with the central bank. And yet the banks have got record amounts of reserves at the central bank. So surely that's got nothing to do with an ideology of the central bank, and it's got everything to do with the risk aversion of the private sector.
So you have to ask the question, how do these reserves get onto the bank, the central bank balance sheet?
Tell me.
Because of actions by the central bank. The central bank can control them. It can increase them and reduce them, and the banks essentially can't do anything about it. In aggregate, what banks can do, and perhaps I should point this out so that there's no misunderstanding, banks can shift reserves from bank A to bank B. So because they all have accounts with the central bank
market, and
so the distribution of these reserves can change. But I've been talking about the aggregate number, the aggregate of bank reserves with the central bank. That one, the banks in aggregate can nothing, they can do nothing about it. It's entirely up to the Federal Reserve.
It's up to the Federal Reserve. The Federal Reserve has pushed it to zero. It's saying, take your money. We don't want your money. Take it. No.
A sort of positive interpretation, benevolent interpretation might be the Fed is trying to give strong hints to the banks. Please lend more, create more credit. When banks lend, they create credit out of nothing, and they don't need reserves for that because they don't lend reserves. And so it's like a hint, why don't you create more money? But they don't even need the reserves for that, and the Fed can just tell them,
Okay, so then finally...
But actually, sorry, one more thing. If the Fed really wanted to encourage the lending, what it needs to do is something else. What would help the banks? A positive yield curve, not a flat or negative yield curve, because you need the long-term interest rates to be higher. You need to earn money. The banks live on the margin. That's how banking works. And that explains why the standard interest rate policy doesn't actually work. I did the first empirical study of the one thing that all economists agree on, whether they're classical economists, David Ricardo 200 years ago, or neoclassical, new classical economists, or even radical economists, Austrian economists, they all agree on one thing. Keynesian economists, post-Keynesian, they all agree on one thing. If you lower interest rates, then you get higher economic growth. And if you raise interest rates, you get lower economic growth. This has been repeated in economics. In fact, we should say equilibrium economics, because they all believe in equilibrium, for the last 200 years. And I've tested this. And of course, central banks use this for their policy. We'll lower rates even to zero, even to negative territory, because it's going to create more growth. Well, what's the empirical evidence for this? And there's never been a study. Can you believe it? For 200 years, they've all been saying this. And they've all avoided doing an empirical study. So I did the first. It's published in 2018. It took me years to find a journal because they all hated this empirical study. Very carefully done with a great econometrician. There's a second paper coming up on this with more countries. We've got in this one the US, the UK, Germany, and Japan for half a century. The conclusion is interest rates. So interest rates, the official story is, should be negatively correlated with growth. Low rates, high growth, high rates, low growth. And the statistical causation should be from interest rates to growth. There needs to be some kind of impact that rates have on growth, right? And the conclusion of the research is interest rates and economic growth are positively correlated. And the causation runs, if anything, then from growth to interest rates. And that's why interest rate policy is useless. It's not the price of money that matters, it's the quantity of money, quantity of credit creation. And that's why lowering rates into negative territory is only going to hurt the banks and do the opposite. So if you want to help the banks, what you need to do is steepen the yield curve. So for that, you need to raise rates. Higher rates are consistent with higher growth.
We have empirical evidence with regard to negative interest rates. And at best, it is mixed. At very best, it is mixed. Yeah,
that's very generous, exactly.
Yeah, very generous. But then you could say it's very mixed because it's deemed to be, in terms of social democracies, a very, very contentious thing that could really rip apart the debtor-creditor thing. Because the fear is you unravel the banking sector, yeah, because your depositors are being charged a rent and they pool money, and you'd rather have the money declared than under the bed. Okay, so my point is, perhaps it gets a bad rap owing to the lack of ambition by those who pursued it, and really, if we step negative, not negative 0.25, but we went negative 3%, you would then have your steepness in yield curve. Is that feasible?
Yes, you can steepen the yield curve by pushing the shorter end into hugely negative territory. But I think that's not really helpful for the banks. So we need the yield curve to be in positive territory and positively shaped. That's what the banks need. They need a positive margin. Therefore, I don't think negative interest rates will work.
Listen, I'm going to end it there. This is, for me, this has been fabulous. I sit there and normally I I only have Google to ask questions. I am asking questions all the time. Now I have you, and it's like you're the font of all knowledge. So thank you for your time, Richard. I hope
Thanks,
this happens again.
Thank you very much. It was great to speak with you. Thanks so much. And I hope we can do this again and continue our conversation.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.